Hello there. My name is Alex Chausovsky. I'm the Vice President of Analytics and Consulting at the Miller Resource Group, and welcome to 3DM, the podcast. If you don't know what 3DM stands for, I invite you to listen to the other recording where I go into the explanation of why I decided to start this podcast. But the main theme here today is really to focus on helping business leaders and decision makers across a wide spectrum of companies and industries make better quality decisions for running their business using data and analytics. And with that in mind, I am so pleased to welcome our very first guest on the show, Danielle Marceau. She is the Principal Economist and Director of Analytics at Prevedere. Danielle, thank you so much for joining me today. It's great to have you here.
Thanks, Alex. Thanks for having me. I'm excited to be here.
Fantastic. So you and I have had some interesting connections in the past, briefly working at the same company for at least a couple of weeks, I believe. But I think that it's safe to say that you've built your career on helping business leaders really improve the quality of the decision making using various types of data. So with that in mind, can you tell us a little bit about your background and how you came to use data to help companies make decisions?
Yeah, absolutely. So, I, of course, have an economics degree and economics background in education. But even throughout my education, I was really mostly interested in the true applicability of it all, much less about the theory behind it, and really interested in how does this affect people and businesses. So kind of early on, there was a bit of a passion for business economics, and I started out in purely a consulting role and started to then sort of develop this interest in data science and more of an analytics focus. And I soon realized that there really had to be a better way to be able to just combine all of the advances that we have seen in computing power and AI and machine learning to be able to automate a huge portion of the consultancy projects that were being done. And what I've had the opportunity to do for the last 8 years is to really do that. I help companies to utilize the world's data at scale to manage market volatility and uncertainty, help them make better business decisions. We do this, I do this through we have a patented machine learning and AI engine, so we're able to help companies identify what external factors are most impactful to their business, quantify the impact of those things, scenario plan and sensitivity test against different economic outcomes or paths, and then monitor all of it in real time as the world around us changes. And it's really powerful because it's one thing to know that an increase in the unemployment rate is going to negatively impact demand for my product. But it's a complete game changer to know that a 1 percentage point increase in the unemployment rate is going to result in a 0.5 percentage point decline in demand for my product, because then it becomes much more strategic and much more tactical. And so that's really where my passion has come from, is that using data to be a lot more tactical and not just at that high level, hey, we know that this is bad for the economy and this is good for the economy, but empowering businesses to actually make decisions with that data. That's really what I have found the most joy in.
It sounds like it's a skill and an asset that is badly needed, because in an environment as uncertain as we've been in the last few years, people are constantly looking for things to validate their decision making. And it sounds like you guys are able to bring a very powerful tool to help them do that. You mentioned a couple of different things. You mentioned demand planning at the company level. You mentioned economics and macro data that you can use to kind of connect the dots between the broader economy and what the company feels at its individual level. What are the types of internal data that you see companies use most frequently? And do you find that there are some that are better for driving outcomes and tactical initiatives than others?
It's a very interesting question that, had you asked me this just 4 or 5 years ago, could have been a very different answer, right? For many years, we had a steady state economy as we were coming out of the great financial crisis. And it didn't really matter as much if you were using dollars, sales, or volume denominated here. Inflation was pretty consistent. You could do sales, you could do dollars, because price changes were pretty much so the same year after year, and they were really predictable and really consistent. But the last 1 to 2 years have highlighted the need to truly understand the business question that's being asked first. And what is the problem that's being solved before you truly understand what the right data is to use. So, if we care about staffing and workforce planning, or if we need to increase our capacity through building a new facility, or demand planning, procurement to know how much input product we need, then we need to be paying attention to volume forecasting and correlating volume to these economic things. But if what I care about is revenue and top line financials and what I'm reporting out to the street, then we care about sales dollars, and we need to include, pricing escalators to truly understand what those dollar sales and revenue, answer is going to be. Commodity prices for input prices. So there's a lot of different things. I think it really comes down to the recent volatility has highlighted the need to truly pinpoint what your business question is and what the problem you're solving is before you kind of go into that, dollars versus volume type of analysis.
Yeah, you mentioned, inflation, and obviously that's been the talk of the town for the past 6 or 12 months or so since early 2022. We've seen a rapid rise. We're now in early 2023 seeing some mild decline, depending on which component of pricing you look at. Services remain stubbornly high, but goods prices, energy costs, certainly some of the commodities you mentioned are starting to come down. I always find it fascinating that profit is oftentimes not the focus of these conversations, because at the end of the day, businesses are there to make a profit, right? And it's almost like, how can you avoid talking about a dollar denominated figure if you know what your input costs are and you know what you're able to sell the product for, what's happening with your profit? Do you ever get into a consideration of profitability and help companies kind of understand the drivers of that for them?
Yeah, sometimes, we'll kind of take a project and kind of answer it from both sides, right? So what is our demand going to be? So, what is our demand and price of that good? And so therefore from a revenue side of things, and then on the cost side, we want to address things like, labor costs and input prices. And it's really becomes multiple models, right? So it's less about, we're not just going to take profit and correlate profit to external factors, but it's let's correlate demand and revenue and answer those questions. And then let's correlate the cost side, the inputs, all of the different costs. There's so many of them. And then sort of the combination of all of those models is how you then can arrive at that profit side of things.
Yeah, it definitely sounds like an advanced user type of analysis, right? Once companies understand both sides of the equation, then they can start to apply it to the big picture view and get down to the profit metrics. Okay, well that helps. I hope helps our listeners understand kind of some of the ways that they can start thinking about their own internal company data and the type of analyses that should be contemplated and leveraged to make better decisions. As far as the flip side of that equation, what kind of economic data do you track and use most frequently, and where can our listeners get access to data like that?
Yeah, so there are thousands of different data sources out there, publicly available. There's a lot of not publicly available data. At Previdary, we have our global intelligence cloud, and that's comprised of millions of model ready time series data sets from thousands of different sources from around the world. A huge portion of that is publicly available, where anybody can go out and gather it. It's from sources like the Bureau of Labor Statistics, the OECD or the IMF, Federal Reserve, the Census Bureau. So there's a ton of that publicly available data out there. The Federal Reserve Bank of St. Louis offers the FRED, which is a data repository that combines data from U.S. data from many of the government sources. That's a great opportunity to grab data for any sort of business analysis if you're just kind of trying to start small. When it comes to assessing bigger, broader macroeconomic conditions in the U.S. as a whole, I have a list of top 10 metrics that I like to look at in really understanding business cycles and the future state of the overall macroeconomy that really are a great starting point for businesses as well. You know, they are higher level in macro, but they're a great starting point. These are covering a wide range of sectors and categories. So they're going to be things that fall into a macroeconomic bucket. They're going to fall into like a business and consumer sentiment type of bucket, and then a consumer spending. Then there's some production and manufacturing, and then housing and construction. And you might be saying, hey, well, my business doesn't really play into the housing market. It's not really that important. Well, these are big, broad macroeconomic trends that they really can ripple through the economy. And they could end up being actually a leading indicator for your business. So, you know, things like consumer sentiment, housing starts, business confidence, ISM manufacturing index or services, architectural billings index, even consumer spending plans and intent. Those are all really great places to start. And a lot of that data is publicly available, even through one source that I had mentioned before with that Federal Reserve of St. Louis.
Yeah, you touched on this very important concept of leading indicators, right? Finding the things that predict what operating conditions are likely to be in the next 6, 12, 18 months or so. I know that there are some that predict even further out, like bond yields and things of that nature. A few of the leading indicators that I have followed myself, PMI is a great one. If you're an industrial company, you know, that tends to lead the economy because it measures the sentiment of future buying activity by purchasing managers around the country. Copper price is another interesting one to consider, right? Because copper is so pervasive in its use across the economic landscape. How can companies identify leading indicators for their specific industry and their company performance? Can you kind of give them a better understanding of what it takes to find a leading indicator for your own company?
So it sounds quite complex, but it is actually very easily doable, even in just an Excel spreadsheet. If you don't have, I'm talking about, hey, we have an engine that's machine learning and AI powered, and that allows us to do this at scale. But at its core, it is something that you can start small with, and just within an Excel spreadsheet, it's something that you can do. And so the first thing that is really necessary is you need to start looking at your sales data probably in a little bit of a different way than you might traditionally look at it. And that's in a rate of change format. Now, yes, you're probably used to looking at, growth this month versus the same month of the prior year, but that tends to be a little bit more volatile. That month to month movement can be filled with a lot of ups and downs. So I recommend looking at it on a 3-period moving average and then year over year. And so what you're going to end up with then is this rate of change or rate of growth. And you'll be able to then see not just that your sales are increasing to the right, the line is up and to the right, but you'll be able to truly see how fast things are increasing or decreasing. And you're then able to see points of inflection. Where you see a transition from an accelerating growth trend into a decelerating growth trend, and really be able to look at the peaks and the valleys in your own sales or business performance data. That's your business cycle. And then once you've identified your own peaks and valleys in momentum within your business, Then you want to start mapping those peaks and valleys to some of these key external factors that I talked about. And again, starting high level, starting with some of like the top 10 macro variables, as I kind of highlighted earlier. And so you'll just want to kind of take a look at those metrics and chart them next to yours in that same 3-period moving average year over year, and start to see, do any of those actually see a business cycle high ahead of or before your sales start to see a business cycle high? And then the same thing for the downside. Because what you'll actually find is that many of these key macro leading indicators, they do lead your business. And that is because the US economy is, I like to kind of talk about it like a roller coaster or a train. So you've got the engine of the train at the very beginning, the forefront of the business cycle. That's going to be things like consumer confidence and housing starts, or just the overall residential construction market. Those things tend to be some of the first that turn down during bad economic times and turn up during good economic times. Think about the great financial crisis. Consumer confidence and housing market were some of the first things to start to go sour. Then you've got things at the back of the train. You've got things like capital expenditures and commercial construction. That's the caboose. Those are some of the last things that actually start to feel an economic turning point. So when things start to go south, those are some of the last things that turn lower. Or when things start to get better, some of the last things to start to turn higher. So because the economy sort of goes through economic business cycles in this sort of predictable manner, if you can actually chart your business cycle of your business and then compare that to some of the things at the front of the macroeconomic business cycle, things like housing starts, consumer confidence, many of the leading indicators I mentioned today, what you'll actually find is they become leading indicators of your business as well, where you're able to see, hey, when consumer sentiment starts to track lower, I've got about 6 months until my sales are likely to start to track lower as well. Or on the upside, right now we're on the backside of the economic business cycle. The economy is softening, things are drastically slowing down. Well, when you start to see a reacceleration in consumer sentiment, maybe that means that about 6 months after that reacceleration in consumer sentiment, you'll start to feel that reacceleration in your business as well. And then that allows you to really be proactive instead of just kind of waiting for that point of reacceleration, being able to use those leading indicators to point it out and point you towards that inflection point allows you to plan a little bit more adequately.
Yeah, I love that explanation. I like to think about it from the analogy of the human body, right? The top line revenue, the things that you feel every day, that's kind of the external perception, right? You see it, you feel it. The rates of change is almost like the heartbeat or the vital signs of that body, right? You can't see them, but they're instrumental in telling you about the health of the person and what's likely to happen in the near-term future, right? So if you're measuring blood pressure and it skyrockets, you might not be able to see it on the outside, but you know that person's probably going to have a difficult time in the near future. So it's a really interesting way of thinking about your business, as you have these things that are externally facing, like your revenue and things that you very easily track every month. But this cyclical pattern that you described, that's present both in company performance and at the macro level in the overall economy, that's more difficult, but it can be calculated. So I love this analogy of using the data and the business cycle to find those key leading indicators for yourself. I love the analogy you described of the caboose versus the back, kind of the front of the train, and figuring out which ones are going to be predictive. Have you at Prevadera, have you been able to help businesses leverage this kind of data to improve the decisions they make in running the organizations? And give us an example of the type of advice that you might give someone based on, for instance, what you're seeing in the macro landscape right now in early 2023.
Yeah. So just a couple kind of hitting on some of the ways that we have, helped customers with this type of analysis. One example that really comes to mind is a large logistics company. They needed a better way to pinpoint peak package volume. So like think about, major delivery company, the holiday season is peak for them. They hire third-party contractors to do a lot of their delivery, and they would both pay those contractors an upfront fee, help with them obtaining the necessary vehicles and such to deliver. And if they did not accurately forecast what that peak package volume was likely to be, they could overhire third-party contractors. And then they would have spent all of this money on onboarding those third-party contractors and then not actually need them. At the same time, the contractors got paid a per package price as well. And if there wasn't enough demand to support all of them, they were not getting that per package price that they were expecting. So their contractors could be upset if they missed their forecast. They could have a lot of unnecessary expenses if they missed their forecast. And they were able to find leading indicators for their peak package season and volume. Many of the things that we just talked about today that became about a 3 to 6 month lead time for them. So things like consumer sentiment, real disposable income, household formations, total new households. And so by tracking their relationship to those things, the next holiday season, they were able to significantly increase their forecast accuracy for that peak package volume. And it was this holiday season, and they were actually alerted ahead of time because of some of these key leading indicators that the holiday shopping season was actually going to be a little bit weaker than expectations. This summer, if you looked at all of the news outlets and you listened to the retailers, everybody was saying that this holiday season was just going to be absolutely phenomenal and it was going to be a rock star season. But at the same time, this company was empowered with these leading indicators that were telling them a completely different story, that were telling them that the consumer was getting a little bit less confident, that real disposable income was declining, that there were some major headwinds coming. And so they were able to kind of hedge their bets a little bit. And they were lowered their forecast and they were able to then improve that forecast accuracy and cut some of those unnecessary expenses. So that's just kind of one example. There's a ton.
Sure. And at the end of the day, it helped them be more profitable, right? Which we talked about the importance of that earlier on. I think it's really important for business leaders to understand that while Prividera has many clients that are Fortune 500 size, right? This methodology is not only limited to companies with vast resources and of scale, right? It can be a small to medium-sized business that applies this methodology to their operation. Would you say that that's accurate? Does it matter, like, for example, what industry you're in or the size of your business?
Industry, size of business, no. The only thing that really matters is we do like to say you need at least 5 years, preferably 10 years of historical business performance so that you kind of have that data to correlate and track to. So it's going to be less applicable to like a brand new startup that's only got 3 years of data. It's really hard to correlate and do business cycle analysis on a startup company. But if you've been an established company, irrelevant of size, irrelevant of industry for 5 to 10 years, then this type of analysis applies and can really empower you to see things ahead of your competition.
Yeah, yeah. I think that's a really important notion is that you can leverage these insights and this methodology no matter what industry you're in and what company size you have. I think it's been an immensely beneficial discussion that we've had. I hope that the listeners are hearing the message, which is they should be leveraging these macro insights, their own company internal metrics to kind of find ways to see around the corner and give themselves a little bit of a heads up in terms of what's going to happen. If they wanted to get in touch with you at Prevedere, how would they go about doing that if they wanted to employ some of your services?
Yeah, so feel free to just visit our Prevedere website at www.prevedere.com. You have access to just our dashboards of leading indicators, which I talked about some of the top 10. I currently publish a monthly update that is completely free of these top 10 indicators. So that gives you access to what the top 10 are, as well as what they're doing. And then that'll give you the information for you to kind of get started on your own. What are the indicators? Where can you find the indicators? And it'll allow you to start doing some of this tracking on your own. If you're interested in Prevedere services, of course, you could then request a demo of our application right there on the website as well.
Absolutely. And I highly encourage you to check out that demo. I think the product is fantastic. And certainly the complexity that Danielle mentioned earlier with the machine learning and advanced algorithms, it's going to definitely give you a leg up on your competition if you do that. So with that, I want to say thank you so much, Danielle, for your time today. We've really enjoyed having you on the show. Thank you so much for the insights that you've shared. And I hope that we'll have a chance to get you back at some future episode to get an update on how things are going in the macroeconomy and what companies are doing about it.
Absolutely. Thanks for having me today, Alex.
Fantastic. Thank you again for all of our listeners for joining this episode, and look forward to more episodes from 3DM, the podcast, in the near future. Have a great day, everyone. Take care.